The Fed has given in. The interest rate correction that Trump has so insistently sought has been set in motion. Rates are falling and will fall further. But is this a good idea? What effects will lower rates actually have? And how will all this affect the markets? Who will benefit most and who will suffer most? Could the federal government be shooting itself in the foot? Well, this is exactly what we're about to look at.
Interest rates are going to fall, but is that a good idea?
The US stock market continues to break records, while inflation rose slightly again in August to 2.9%. This is almost 1 point above the Fed's 2% target. What's more, the so-called core consumer price index, which excludes food and energy, which tend to have more volatile prices in the short term, is already above 3.1%. And it's not just about the stock market and inflation. The economy is also growing. But then, if the stock market is at record highs, the economy continues to grow and inflation is rebounding, why lower interest rates right now? Well, that's exactly the question many economists are wondering. The answer? Well, despite everything, the American engine is cooling down. And as you know, there's nothing that Trumpism fears more than a declining economy. But clearly, tariffs, the noise generated by this administration, constant changes, uncertainty, the immigration war, all of this is causing the economy to slow down. Without going any further, according to estimates by Moody's Analytics, right at this very moment, US states representing a third of the entire national economy are already in recession. We're talking about states such as Georgia, Ohio, New Jersey, Illinois, Virginia, Iowa, Oregon, and Washington, which are already clearly in recession. What's more, the so-called core consumer price index economy is already slowing down. As a matter of interest, do you know which sector is most affected by this economic slowdown? None other than industry, the very sector that tariffs were supposed to save. But for now, well, let's just say that US factory activity declined in August for the 6th consecutive month. Of course, that's a topic for another day, so let's not get sidetracked. The fact is that the same thing is happening with employment. For example, in July, the ratio of job openings to unemployed persons fell below 1 for the first time in more than 4 years. Be that as it may, even though the economy continues to grow despite everything, even though inflation is rebounding, and even though the stock market continues to break historical highs, interest rates are falling. This is what Donald Trump fundamentally wants for 2 reasons. First, to prevent the economic slowdown from taking hold at the national level. And second, because during his second term in office, he wants to repeat the pressure cooker strategy he implemented during his first term. And what does this pressure cooker consist of? Well, more government spending, lower taxes, more liquidity, fewer immigrants, and lower interest rates. The goal? To tighten and heat up the national economy at any cost in order to achieve very quick results. To boost the stock markets, improve wages, increase profits. In short, to stimulate the US economy during his years in the White House. This explains why he's been so obsessed with lowering interest rates, to the point of publicly clashing with Powell and becoming the first president in history to fire a Fed governor, Lisa Cook. A dismissal, incidentally, that has now been blocked by the courts. But anyway, none of that matters now because interest rates are going to fall, which, in theory, is expected to stimulate the economic engine of the United States of America. But hold on, what if that's not the case? David Kelly, JP Morgan's chief global strategist, he's saying to be very careful because this time things may not be so straightforward.
Those rooting for near-term Fed easing should recognize that lower short-term interest rates could weaken rather than strengthen demand.
In other words, lowering interest rates may have the opposite effect to that desired. Why? Well, according to Kelly himself, there are 5 possible ways in which lowering interest rates could be counterproductive. Pay close attention to this story and everything we're about to tell you. What we're going to see may challenge many of your preconceptions. In recent years, there has been much talk about the federal government deficit, but the truth is that this has not been the general trend. On the contrary, both families and businesses have greatly improved their balance sheets and accumulated a large mountain of assets. For example, households have 4 times more demand deposits and money in checking accounts than they did at the end of 2019, and money market fund holdings have also more than doubled. The overall result? Total holdings of cash and equivalents by households have skyrocketed 45% since before the pandemic. And so, by the end of 2024, US households had accumulated $14 trillion in deposits, money market funds, and short-term investments. In other words, precisely the products that benefit most from high interest rates. And this means that if interest rates end up falling by 1 point, it could cost families $140 billion in lost income per year. In fact, according to JP Morgan's team, higher rates have benefited rather than punished families, which would explain why consumption data has been stronger than expected in recent years. The fact is that families are in very good financial health, with financial assets of around $125 trillion and total liabilities of around $20 to $21 trillion. That is a substantial difference. Not only that, but the bulk of the liabilities correspond to fixed-rate mortgages at historically low levels. That's why JP Morgan believes that a 1-point drop in interest rates could cost families $140 billion per year in interest, while only reducing their financial expenses by about $30 billion. In other words, the negative balance would exceed $100 billion. And take note, because companies would not particularly benefit from this situation either, it turns out that they are also very healthy. In fact, rate hikes have meant that families have earned more interest, while companies have paid less. They've paid less because they have less debt. The result, even taking into account corporate savings, the combined result is that the private sector in the United States loses tens of billions of dollars in income each year. In other words, only the government would win here. And all this in a context where inflation is rebounding and where tariffs and migratory pressure are going to put even more pressure on prices. Put another way, between one thing and another, we could be facing a significant reduction in consumer spending, which, naturally, could further fuel the general economic slowdown. But this is only one of the possible negative consequences of the rate cut. But aren't lower rates supposed to stimulate higher levels of spending and investment? After all, if it's easier and cheaper to borrow, why wouldn't families and businesses do so? Well, over at JP Morgan, they say it's not that simple. First, because there's already a lot of liquidity in the system, and rates are not high enough to deter transactions in a private sector that is healthier than ever. In other words, lowering rates will not unlock large investments. Second, because investment depends on the cost of long-term financing. And here, it's not only the Fed's benchmark interest rates that have an effect, but also estimated inflation and long-term interest rate expectations. And of course, if this rate cut is seen as an eminently political move, it could mean that the reduction in the cost of financing would be much smaller than the cut in the benchmark rate.
If markets perceive that the Fed is responding to political pressure and that the risk of higher inflation and higher deficits in the long run is growing, even substantially lower short-term interest rates might not lead to much of a reduction in long-term interest rates.
Pay attention to this idea. This is also an important concept. You see, one of the ways in which lower rates usually leads to more demand and more consumption is through the wealth effect. That is, with lower rates and lower financing costs, asset prices must increase. As the price of assets such as housing increases, families feel wealthier and are more likely to spend. However, for David Kelly's team, this time could be different. Liquidity is already high, which has caused virtually all asset markets to reach record highs. Real estate prices are at record highs. The stock market is at record highs, and at historically high multiples. Junk bonds are trading at almost no premium. Private equity has flooded the economy with money in recent years, etc., etc. The result? Well, the wealth effect may be limited or non-existent. And even if it did occur, it could simply be fueling a dangerous financial bubble. Or perhaps it could simply be fueling the rapid decapitalization of American families as they buy expensive cars. Whatever the case, this possible limited impact on asset values is closely related to the new theories that say that what really matters, what really drives the modern economy, is not interest rates, but liquidity. And yes, in recent years, there have been gigantic mountains of liquidity, which relegates the issue of interest rates to second place. But let's continue. The dollar had a stellar few years against other currencies around the world, precisely due to its relatively higher interest rates. The arrival of Trump marked a turning point. So far in 2025, the US currency has depreciated by more than 12% against the euro, for example. And now, the rate cut could cause further declines in the coming months. And what problem does the JP Morgan team foresee? That a lower dollar will also make imports more expensive, both for capital and consumer goods. And although this may be good for the export sector, they say that its potential is more limited, and that, on top of that, the damage from more expensive imports will come first. In other words, once again, less purchasing power for families and businesses. And with that said, we come to the last point. What does the Federal Reserve know? Lowering interest rates could end up consolidating a change in narrative. And no one invests when it looks like lean times are ahead, but that's not all. There are more questions. How far will the rate cut go? Why not wait? This, in fact, is a point where, according to the JP Morgan Trump team, he is absolutely correct. If you want to lower rates, you have to do it all at once. Gradualism is bad because it can cause investors to prefer to wait for lower rates. This would greatly reduce any positive impact on demand. Well, there you have the 5 ways in which JP Morgan believes that this time around, the rate cut could even have a contradictory effect. 5 specific situations, to which we can add one more. If the market becomes convinced that the White House is already basically controlling the Fed for political and electoral purposes, this could cause irreparable structural damage to the dollar and investment in the United States, which clearly would be bad for the US economy. This is, for example, what Ken Griffin, founder and CEO of Citadel, and until recently, one of the Republican Party's biggest donors, is saying.
Billionaire hedge fund boss Ken Griffin to Trump. Don't mess with the Fed. These actions raise inflation expectations, increase market risk premiums, and weaken investor confidence in U.S. institutions.
So as you can see, this time things could be a little more complicated than they appear at first glance. And even if the risks we have seen do not materialize, and the cut does have expansionary effects on the asset markets, be very careful, because we're already at very high valuation levels. So what does this mean? Logically, it means we have to be much more selective. And don't forget what typically happens when a government insists on lowering interest rates for political purposes. The results have always been disastrous. And it doesn't matter whether we're talking about Erdogan's Turkey or Nixon's United States. So let's be cautious before getting too excited. In any case, it's clear that this measure will have big winners and big losers. The big winners? Almost certainly the digital industry, and particularly the industry linked to artificial intelligence. Why? Because they won't suffer most of the negative effects we've just seen that rate cuts can have. And on the contrary, they are currently implementing major investment plans. They will now be able to finance these more cheaply. What's more, the depreciation of the dollar will also improve their business results. In other words, more fuel for an industry that is going from strength to strength.
Evidence suggests a new bellwether may be emerging: artificial intelligence. In the first half of 2025, AI-related capital expenditures contributed 1.1% to GDP growth, outpacing the US consumer as an engine of expansion.
On the other hand, much of the industrial sector may suffer, especially those industries that depend on the purchase of capital goods abroad. These will be much more expensive due to tariffs, and also the depreciation of the dollar. That said, if you want to know more about how all these changes will affect specific sectors and fields, there is one thing you can do: subscribe to Visualeconomik if you haven't already done so. Because in the coming months, we'll be talking a lot more about this. Don't forget to like this video if you found it interesting. Thank you so very much for watching. Take care. I'll see you next time.